Silver didn't just rally, something in the plumbing snapped, and now the real market is starting to price itself. The conflict is simple. The headline crowd keeps arguing about sentiment, while the structure crowd is watching pressure build in the places that can be faked for long. And if you catch the hidden tell early, you'll know what level actually matters next week, what would confirm the next leg, and what breaks if this move loses its spine. Because this isn't a normal risk-on pop. This is silver shifting from a trend market to a stress market, and that's a different animal. When an asset moves from people want it to people need it, the tape gets louder, liquidity gets thinner, and the pullbacks stop being polite. They become tests, and silver is running those tests in real time. Early this month, it was trading around the low 70s an ounce, then it sprinted into the 80s, and it didn't stroll into the 90s. It lunged. By mid-month, it printed into the low 90s with the kind of velocity that makes even hardened metals people blink, and then it started throwing around multi-dollar daily swings like, that's just the new normal. That speed matters. Not because up is good, but because speed is often the fingerprint of constraint. Someone is chasing, someone is covering, someone is getting risk managed, and the market is not offering enough liquidity at the old price to satisfy it. And that's where the real pressure starts. Now here's where most people get emotionally hijacked. They see the rip, they assume it's overextended, they wait for the pullback, and then when the pullback shows up, it is not a gentle dip, it is a sudden drop that feels like a trap door. It makes you question the entire thesis in one ugly candle. That's intentional, even if it's not orchestrated by a villain with a joystick. It's just how markets with thin liquidity and heavy positioning behave. They weaponize volatility, silver especially. It will make you feel smart for hesitating, then punish you for hesitating, then punish you for participating, all within a week. But the dip isn't the story. The dip is the diagnostic. Because in a true phase change, the sell-off didn't reset the chart the way it would in a normal bull move. It reveals who can't hold their position anymore. It reveals who is forced. And forced flows are the one thing that can overpower fundamentals in the short run while still aligning with fundamentals in the medium run. But that's not the part that matters. The part that matters is the hidden detail that reframes the whole thing. The price is not always the truth in silver. Spreads are. When the physical market tightens, it often shows up first in the cost of carrying metal, borrowing metal, and getting deliverable metal on time. That's the unsexy layer most people ignore, because it isn't a simple chart screenshot. But in metals, especially silver, the plumbing is the story. Futures can print any number in a thin moment. Physical bars can't teleport. And the gap between paper urgency and physical availability is where silver turns feral. Think of the silver market like a city's water system. And the faucets in your house are the spot price everyone stares at. The pipes and pumps are the spreads, the leasing, the inventory categories, the delivery mechanics, and the financing. If the faucet pressure spikes for 5 minutes, that can be noise. But when the pipes start groaning, when the pump is straining, when it costs more to get water delivered to the top floor, that's structural. That's constraint. That's new phase. And if you want to know whether this move has teeth, you watch the plumbing. Because if this one level breaks, the math changes. Let's make the mechanism painfully clear without turning this into a lecture. Paper silver, futures, swaps, unallocated claims can expand and contract quickly. It's a financial instrument. It's cheap to trade. It's leveraged. It's used for hedging, speculation, and inventory management. Physical silver, the bars that satisfy delivery obligations, the metal an industrial buyer actually consumes, the inventory that can actually move through logistics, has lead times, fabrication constraints, and financing constraints. Those two worlds usually stay loosely connected through arbitrage. If paper gets too rich or too cheap relative to physical, someone steps in. They buy here, sell there, move metal, earn the spread. In calm markets, that keeps things tidy. In stress markets, the arbitrage becomes difficult or expensive because the risks explode right when the opportunity appears. That's the key. The spread can widen not because people are dumb, but because balance sheets, haircuts, transport, and timing risk choke the trade. And when the fixers can't fix fast enough, dislocations persist, and price discovery gets jumpy. That's when the move feels like it came out of nowhere. It didn't. The pressure was there. It was just hidden in the pipes. Here's the second trap people fall into. They hear inventories, and they assume it asks one number. It's not. In silver, you can have headlines that scream tons in vaults, and still have a shortage of the specific metal that matters for settlement at the moment it matters. That's because there are categories. There's metal that exists, and metal that is deliverable under certain rules, in certain locations, with certain bar specifications, on certain timelines. There's metal that is technically in a vault but not available because it's owned, encumbered, pledged, or simply not for sale at the price implied by paper. There's metal that can't be moved quickly without cost or friction. And then there's the deliverable float that actually meets the contract specs when the market calls for it. That's the difference between inventory and available inventory. It's like saying a grocery store has food, while ignoring that the only thing you need for dinner is eggs, and the eggs are gone. The shelves can look full, and you still have a shortage where it counts. But the next detail is what flips the whole setup. London matters. Not because London is magical, but because it's a core hub of the OTC precious metals market. It's where a lot of unallocated and allocated silver counting converges. And the Vault Holdings data is one of the few transparency windows the market gets. Recent Vault data showed London's silver holdings ending December at roughly 27,118 tons. That sounds huge. And it is huge in absolute terms. But huge is not the same as liquid. What matters is the change, the float, and the stress points when demand spikes or when financing tightens. If the market is pulling more metal into places it needs it, or if a big chunk is effectively locked, the marginal availability can shrink fast, even if the total looks stable. And marginal availability is what sets price in a squeeze. Always. So when you see silver jump in a way that doesn't respect the old rhythm, you're not just seeing buyers. You're seeing the marginal seller disappear at the old price. That is why this feels like a new phase. It asks less about a steady stream of optimistic bids and more about price having to leap upward to find metal, liquidity, and risk tolerance. And that's where the real pressure starts. Now layer in the behavior on the street, because street-level symptoms are often the first honest signals. In the middle of this surge, reports from coin dealers and retail channels have been weird. Instead of the classic retail frenzy, there's evidence that a lot of U.S. retail has been selling into the rally, more sellers than buyers, while bigger flows appear to be coming from institutions and overseas demand, especially in Asia. That matters for two reasons. First, retail selling into strength can act like a temporary relief valve. Some metal comes back to market. Second, it tells you the move may not be powered by pure mania. If the engine is bigger money and industrial or regional demand, the structure can stay tight longer. Retail is emotional and fast. Institutions are systematic and persistent. Industrial procurement is boring and relentless. And the boring flows are the ones that grind markets into new regimes. But that's not the part that matters either. The part that matters is what this kind of flow mix does to market structure. When volatility rises and price gaps, risk managers step in. They don't care about your thesis. They care about exposure. If you're short and the market is moving against you, your margin requirements rise. Your losses rise. Your ability to wait decreases. At the same time, if you are long with leverage, the same volatility can shake you out even if you're right. That's how silver weaponizes both sides. It's not personal, it's arithmetic. And in a high volatility environment, arithmetic creates forced buying and forced selling. Now, there's an extra accelerant people underestimate: options and gamma behavior. You don't need a textbook to get the intuition. When there's a lot of options activity around key strikes, the dealers who sell those options hedge dynamically. In certain configurations, rising prices can force hedgers to buy more as price rises, which can amplify the move. In other configurations, a sell-off can force selling that accelerates the drop. This is why silver can feel like it's being pulled by a magnet one day and shoved off a cliff the next. It's not always a neat gamma squeeze, but the reflexivity is real. Positioning interacts with price, and price interacts with hedging, and the loop feeds itself. The market becomes its own catalyst, and that's why the calendar matters so much right now, because liquidity is not constant through the month. It thins around certain windows: post-holiday repositioning, month-end rebalancing, roll periods, settlement and delivery considerations, option expiries, and the moments when big funds adjust exposure mechanically. In January specifically, you get a cocktail. New year reallocation, fresh risk budgets, tax-related flows, and a market that's still rehydrating after holiday liquidity. In thin liquidity, a normal imbalance becomes a price air pocket. In thick liquidity, it becomes a shrug. Same imbalance, different result. And this week has been the kind of week where a small shove becomes a headline move. Because if this one level breaks, the math changes. So what is the hidden mechanism that few expected? It's that silver's new phase isn't primarily about a story. It's about the carrying system getting stressed while participation changes. When the cost to source and move silver rises relative to the convenience of trading paper, the market starts sending signals in the curve and the spreads. In plain terms, if nearby metal becomes relatively more valuable than future promises, you'll often see the market flirt with backwardation, or at least show unusual tightness in nearby spreads. Even if you don't have perfect visibility into every spread tick, you can infer it from behavior: sudden surges, abrupt pullbacks, difficulty calming down, and persistent demand despite higher prices. That's the tape telling you the marginal metal is hard to coax out. Meanwhile, the macro layer is adding fuel in a way that's easy to misunderstand. A stronger dollar and shifting rate expectations can pressure metals in the short term by raising the opportunity cost of holding non-yielding assets and by tightening financing conditions. And we just saw that. Stronger US data bolstered the dollar, gold and silver pulled back, and suddenly the turning point narratives came out. But macro doesn't have to be bullish for silver to have a squeeze-prone structure. Macro can actually make the structure more unstable by tightening financing and balance sheet capacity at the exact moment the market needs more arbitrage to keep paper and physical aligned. That's the paradox. Tighter financial conditions can reduce the ability of the system to smooth dislocations, so you can get sharper spikes and sharper drops, and that's where the real pressure starts. Now let's stack proof, because one argument is never enough in this crowd. Proof point 1 is the speed and range, moving from roughly 71 per ounce at the start of January to above $90 in the middle of the month is not a sleepy drift. It's a repricing. Proof point 2 is the volatility regime. The market is throwing wide daily ranges and sudden reversals, which is typical when positioning and liquidity are driving as much as fundamentals. Proof point 3 is the flow mix. Credible reports indicate U.S. retail investors have been net sellers into the surge, which implies the marginal buyer is not the usual headline villain or hero. It's bigger, quieter, and possibly more price insensitive. Proof point 4 is the inventory nuance. The existence of large vault totals doesn't negate tightness in deliverable float, especially when specific categories matter for settlement and timing. Proof point 5 is the macro financing angle. Dollar strength and shifting rate cut expectations can pressure metal prices while simultaneously increasing the cost and difficulty of the arbitrage that normally keeps the market orderly, which can actually increase the probability of dislocations. Proof point 6 is the on-the-ground friction. In retail channels, you can have a glut of certain forms, like older coin supply, while refiners and fabricators show reluctance or constraints processing it quickly, which creates weird pockets where there is plenty and there is none are both true depending on what form you need. Those are stress market fingerprints. The market is not smoothly clearing, it's clearing in chunks. And the next detail is what flips the whole setup. The chart level everyone stares at is not the only level that matters. In a phase change, structure levels become triggers for forced behavior. When silver tagged into the low 90s, it wasn't just a nice round number away from 100. Boy, it was a zone where a lot of risk systems wake up. Shorts reassess, hedgers rebalance, and sidelined money that has been waiting for confirmation suddenly has to decide whether to chase or miss. That's when you get the violent continuation risk, gaps, air pockets, and the kind of move where the market is already 3 higher by the time you finish your thought. But, and this is crucial, this is also where the controlled pullback scenario is most likely, because the same systems that chase can also de-risk. You can absolutely see silver pull back hard even if the thesis is right. Volatility can whip around violently even if the underlying pressure is building. You have to separate trend signal from noise. Trend signal is the market holding higher zones and recovering quickly after stress tests. Noise is the intraday chaos designed to shake you out of a position you can't explain. But that's not the part that matters. What matters is what to watch next in a way that doesn't rely on prophecy. Start with the map that price itself just drew in January. The obvious resistance area is the recent peak zone in the low 90s, call it roughly $93 to $95, as the immediate ceiling region the market has already probed. Above that, the psychological magnet is $100, not because numbers have feelings, but because order flow changes around round numbers. Funds rebalance, stops cluster, headlines amplify. That's a structural reality. On the downside, you have a staircase of supports carved by the surge. The mid-80s zone is a first major battleground because it's where a lot of late buyers will anchor their I am still okay line. Below that, the high 70s area matters because that's where the market transitioned from rally to launch. If price breaks back into that region and can't reclaim it quickly, you're no longer in a clean, squeeze-prone continuation, you're in a deeper reset. And then there is the foundational floor of the month, the low 70s where this phase began. If silver ever revisits that region quickly, it would tell you the pressure vented hard, positioning washed out, and the market is rebuilding from a different base. That doesn't kill the long-term story necessarily, but it changes the near-term setup dramatically. Because if this one level breaks, the math changes. Now for confirmations that aren't just price went up, confirmation looks like this. Pullbacks that get bought faster than expected, recoveries that happen in fewer sessions than the drop, and price holding above those mid-80s and high 70s battlegrounds, even when the dollar firms or when risk markets wobble. Confirmation also looks like continued evidence that larger flows are behind the move, ETF flows, institutional positioning hints, overseas demand, and the street symptom of retail not being the dominant marginal buyer. If you see retail suddenly become euphoric and pile in at the exact time the market is stalling under resistance, that's not necessarily bullish near term. That can be a contrarian warning that the move is shifting from constraint-driven to emotion-driven. The market loves to hand the bag to the loudest participants. That's how it stays funded. Meanwhile, an important confirmation is the e-plumbing behaving like tightness, persistent urgency in nearby pricing relative to later pricing, elevated cost of sourcing, and continued signs that arbitrage isn't instantly smoothing everything out. You don't need to pretend you can see every swap and lease rate tick. You can read it through behavior. If the market stays jumpy, if dips are sharp but recoveries are sharper, if the structure refuses to calm down, that's often tightness. A weakening signal looks like this. Price breaks down through key support zones and stays there. Rallies become slower and fail under old support. Turn to resistance. Volatility remains high. But the bounces get weaker, and the narrative flips from cannot find metal to plenty of metal with visible easing in premiums and urgency. Another weakening signal is macro tightening that actually crushes demand and improves the system and its ability to arbitrage. If financing conditions and balance sheet capacity improve while physical demand cools, the dislocations can fade and the market can revert to a more orderly curve. That's the counterpoint, and it's real. There are mechanical ways this move stalls. Demand destruction is one. At high enough prices, industrial users look for substitution, thrift, and inventory drawdown. They don't do it instantly, but they do it. Another is policy surprise. If rates stay higher for longer than the market expects, if the dollar strengthens materially, that can pressure the entire complex and reduce speculative appetite. Another is a positioning reset. If enough shorts have covered and enough late longs have been shaken out, the forced flow engine can pause. Another is supply response at the margins. Recycling flows can increase, scrap can come out, and if refiners are incentivized, bottlenecks can ease. None of these are guaranteed, but they are the mechanisms that would weaken the new phase feel. And that's where credibility lives. You don't marry one outcome. You watch which mechanism is winning. But that's not the part that matters most for you watching this right now. The part that matters is the psychological shield, because silver will try to emotionally mug you. First, it will seduce you with momentum. Then, it will punish you with a brutal dip that makes you feel stupid for believing. Then it will bounce without you, to punish you for panicking. That cycle is how volatile assets transfer conviction from the impatient to the patient. The defense is simple, but not easy. Decide whether you're watching a trend signal or noise. Trend signal is the market defending higher zones and making higher recoveries. Noise is the intraday chaos that exists specifically because liquidity is thin and positioning is heavy. If you can't explain why a dip might happen mechanically, margin pressure, hedging flows, thin liquidity, calendar windows, then you're vulnerable to narrative whiplash. You'll let the market tell you what to feel, and it will. So instead, you run a two-scenario lens and you stick to it. Scenario 1 is the controlled pullback and retest. Silver dips maybe violently into a support zone, churns, scares everyone, and then reclaims key levels with improving structure. That scenario is how strong trends breathe. It's ugly, but it's healthy. Scenario 2 is the continuation squeeze. Silver holds above the battleground zones, liquidity stays thin, and the next wave of forced buying hits into resistance and blows it out. That scenario is where gap risk lives. It can move faster than your comfort. It can also reverse faster than your confidence. In both scenarios, the rule is the same. Price can whip around violently even if the thesis is correct. Volatility is not a contradiction, it's a feature. And the calendar is still the catalyst. As we move deeper into the month and toward the next key windows, rebalancing, roll behavior, and the market's constant cycle of exposure adjustment, the odds of big swings remain elevated. So what do you do with that? You watch the levels and the behavior around them. You watch whether dips get bought quickly or fade slowly. You watch whether recoveries look forced or effortless. You watch whether the market keeps behaving like it's short of liquidity at the margin. Because in a true phase change, the market doesn't politely return to the old range and stay there. It either consolidates above the old ceiling, or it breaks down in a way that tells you the constraint story was overplayed. And if you're tempted to think this is all just drama, remember the core idea. Silver is both a monetary metal and an industrial input. That hybrid identity is exactly why its moves can be so violent. The macro crowd and the supply chain crowd collide in the same instrument. When they align, the move is powerful. When they fight, the whipsaws are brutal. And that's where the real pressure starts. So here's the near-term checklist in plain language, without hype and without paralysis. First, respect the recent high zone in the low 90s as the immediate ceiling the market has to chew through. A clean break and hold above it increases the probability of a fast run toward the next psychological magnet. Second, respect the mid-80s as a key battleground. Holding above it on pullbacks keeps the continuation structure alive. Third, treat the high 70s as a deeper line in the sand for the new phase narrative. Losing it and failing to reclaim it suggests the market is venting pressure and resetting. Fourth, watch the plumbing behavior through whatever windows you have. Spreads, premiums, availability chatter, and the simple question, does the market calm down or does it stay tense even after a pullback? Persistent tension is information. Fifth, keep your psychology clean. Don't let a one-day move rewrite your entire worldview. Silver is designed to do that to you. And if you're the kind of investor who wants mechanisms over slogans, structure over vibes, and a roadmap instead of a prophecy, you already know what to do. You don't chase every candle, you don't panic every dip, and you don't outsource your conviction to a headline. You build a thesis, you define what would confirm it, you define what would weaken it, and you let the market show you which world you're in. If you stay with the people who watch the signals the mainstream ignores, the plumbing, the incentives, the structure, you'd all see the turn earlier and you all get less emotionally taxed by the noise. Because the next week or two in silver won't be about who has the hottest take. It'll be about who understands what stress looks like before it's obvious, and who recognizes that when silver enters a new phase, it doesn't announce itself politely. It makes the entire market feel it.